Okay, let's get going. Let's get going. And as Jasmine said, this is the first one of 2024, and I can't believe that we didn't have one in January. And I wonder really if we should have had one to prevent this being such a bumper one. But Happy New Year to everybody, or as we say, blwyddyn newydd dda, as we say in Wales. So let's get going with what I've got to talk about in February, and start off my normal the agenda of what I want to talk about. I think as it's the first one, I need to transition from 2023 into 2024. So we'll just recap a couple of bits from the autumn statement, which it seems ages ago now. And then after the autumn statement, we had the Scottish and the Welsh budgets. And that's always the way that it will be. The Scottish and Welsh budgets have to have their budgets after the autumn statement, because it's only then that they know about the funding and what the UK government is going to do. So the UK government is going to do that. Oh, we can do this. So that's why the Scottish and Welsh budgets are so always after the autumn statement. Then it's only a month until we've got the UK budget. So we're still talking about the autumn statement, but in a month's time, we've got the UK budget. And oh my word, goodness only knows what that is going to bring. So when I talk about finishing 2024-25, we knew an awful lot of information. A lot of information came out in the autumn statement. So we knew what was going on, but there was a lot of bits and pieces that we didn't know from a payroll perspective. Now we do know those bits and pieces, but there's just one really that's outstanding. So I wanted to talk about that because I have been, as we go through, as we get the information, I have been giving you that information. So it only makes sense to fill in the gaps. Then, okay, we will talk about some changes that are coming in, all to do with amendments to the working time and all to do with employment law amendments to Great British employment law. First one, I think, that you should really be aware of, and I have talked about it before, is changes to statutory paternity leave and pay. That must be in your systems from April, and you must understand what's going on. Then I know everybody will be really excited, changes to holiday leave and pay. And that's all to do with amendments to the working time regulations. So I want to try and go through that in a structured way. And then, my word, well, I must admit, I did know that it was coming. So it isn't a surprise that it's coming, but the voluntary payrolling of benefits will no longer be voluntary from 2026. It seems ages ago. However, it's only 2 years, or less than 2 years. And there's an awful lot of prep that we've got to be doing with ourselves, our systems, our knowledge, and our clients as well, before we can actually start the mandatory payrolling of benefits in kind in April 2026. So that's tax year 26-27. Okie dokie, let's start off. Oh, my favorite. Oh, I was so excited to see the restoration of devolution in Northern Ireland. Doesn't only affect you if you have employees in Northern Ireland, because if you do UK payroll, you have to think UK wide, and Northern Ireland is part of the United Kingdom. And I was on a meeting last week with His Majesty's Revenue and Customs, talking about some changes to employment law that are coming in this year and maybe later on this year. And I said, yeah, I don't understand. It says it's only applicable in England, Wales, and Scotland. But what about if you've got somebody in Northern Ireland working on a Great British contract, which absolutely does happen? Does that mean that they're not entitled to it? Because my understanding from an employment law perspective is that they are entitled to it. Oh, no, they're not entitled to it. Then somebody else popped up. Well, they might be entitled from a leave perspective, but not a pay perspective, because from a pay perspective, they've got to be working in Northern Ireland. So I said, please don't tell me we've got the situation where they might be entitled to leave. but they're not entitled to the pay, then you're looking at a totally different kettle of fish as regards, and it was all to do with employment law and statutory payments as well. So I'm glad they're back up and running. They've got a lot of catching up to do. 2 years they've been out. 2 years we've got to, or Northern Ireland's got to catch up with all of the changes that have happened in Great Britain. Anyway, enough about Northern Ireland. Let's go back to the autumn statement. And actually, that slide is really interesting as well. For me, who's really boring, green book. An autumn statement is always accompanied on gov.uk by a green book. Okay, so the big announcement in the autumn statement was the reduction in national insurance. The main national insurance went from 12 to 10, 5.85 to 3.85 for paydays on and after the 6th of January. Why did he choose the 6th of January? When you saw the 6th of January, you thought, must be an early election. You don't know. Very strange. He chose the 6th of January, right nuisance for payroll professionals. Hopefully you've done that in your software for your employees. Just a quick note on there, the NICS thresholds and the rates are frozen for next year, as far as we know, but what's going to happen in the budget? You don't know what's going to happen in the budget. So everything at the moment is, as far as we know, this is going to happen. But in a month's time, the budget could change everything. But at the moment, for 2023-24, your employees are paying 10% national insurance rather than 12, 3.85 rather than 5.85 if they're paid on and after the 6th of January 2024. What about your directors? So this is not somebody that's called employment director, payroll director, but really they're an employee. This is your true directors, registered as a director. And they have an annual earnings period, an AEP. We, a normal employee, have pay national insurance as we earn the money. So a weekly threshold, a monthly threshold. Directors have an annual earnings threshold. So because of the mid-year change of national insurance rate, they have a blended rate for this tax year, 23-24. Excuse me. So, right. As I've said, blended rate. How do they get the blended rate? Well, simply 9 tax months were at 12%, 3 tax months are at 10%. So the blended rate is 11.5. And there's 3 situations. There's the director that's to be paid, i.e. they get their once-off payment, their annual payment, maybe in March, which is quite common. Or you've got a director that's already been paid. Maybe they get paid once a year, but they get paid in December or November or July or something like that. So what does the blended rate mean for people that have already been paid, your directors that have already been paid? And what about the directors where we put them through the payroll on a monthly basis? They're still directors, so they're still subject to the annual earnings period. However, we take national insurance from them via the alternative method. So we collect on a monthly basis, on a weekly basis. So what about those? Well, simply, if they are yet to be paid, so they've been on your payroll, maybe they're on an annual payroll, they've been on your payroll and they have not been paid, maybe they get paid in March, their salary, which is traditionally just below the tax threshold, but above the national insurance one, so it counts as a qualifying year for state pension, all that kind of thing. Simply, when you pay them, use the blended rate of national insurance. That's 11.5. If you've already paid them, so you've got an annual payroll, maybe it paid in December, you will have taken national insurance probably at 12%. You need to recalculate that payroll now. If they're still in employment, what about the director then that's left your employment? So you've paid them in December, say, and they've actually left your employment. Well, can you do a recalculation then? They've left your employment. They're no longer a director. There's nothing that you can do. HMRC will have to sort that out. What about the directors that are on your monthly payroll? So they pay national insurance with the rest of your employees based on the earnings in the month. Well, when you come to do your annual reconciliation in month 12, and that's what you're supposed to do, you look at the annual earnings period, work out national insurance, calculate what they should pay, and versus what they did pay in the payroll, and then you do a comparison and an adjustment in their final payroll. This year, when you're doing that reconciliation in the final period of the tax year, you've got to use the blended rate, 11.5%. But it's the directors that you've paid that have left, that a lot of people are saying, oh, you've got to contact them, you've got to recalculate and give them national insurance back. They've left. You don't have to do anything. They've left. It's only if they're still employed that you have to think, oh, well, they paid national insurance at a higher percentage. I should be at it should be at a blended percentage. I've got to do a recalculation, and that will mean an extra payment through the payroll. The problem there could be that if you do an extra payroll, which will result in an extra full payment submission, extra FPS, HMRC systems might think this is an annual payroll, but I've received 2 FPSs in this tax year. Oh, do you know, probably what the employer has done is they flagged it as an annual payroll, but it's meant to be a monthly payroll. So I'll change my thinking. I'll expect an FPS every month. But if you're only sending an FPS once a year, what HMRC systems will do is say, but I wanted one every month. Well, I haven't got one. They must have filed late. So I'll charge them. I'll give them a penalty. And you get penalty, 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 and you'll have to appeal, appeal, appeal. What you should do if you've having to do a recalculation for a director, so pay some national insurance back to the director, resulting in a net pay payment, is you should flag that FPS with a late filing reason. I think it's H, isn't it? Correction to an earlier run. You don't want to send another FPS because an annual payroll, HMRC systems will think, annual payroll, I'm only expecting once a year. I've got 2. They must have made a mistake. I'll set one up to be received monthly. That's the only consideration there. 2 bits of guidance. You've got the CA44, the Bible of Directors' National Insurance. You've got 2 this year. One to the 5th of January, one from the 6th of January, 2024. Okay, moving on. Autumn statement happened. Then the Scottish and the Welsh governments thought, well, I know what's going to happen. I know what the Chancellor of the Exchequer is going to do next tax year. I can do my budget now. And both were done on the 19th. Now, the tax sharing powers in Scotland are different from the tax sharing powers in Wales. In Scotland, they've got much more say on what happens because they can set their own rates of income tax and they can set their own thresholds as well. In Wales, all Wales can do is vary the UK rates or the rest of the UK rates. So that's your 20, your 40 and your 45. So they've got limited powers in Wales. They want more and perhaps they'll get more should a different government be in place in a few months' time. Perhaps they'll get more. But at the moment, Scottish income tax can do whatever they like with regards to rates and thresholds. Wales can only vary the 20, the 40 and the 45. Northern Ireland, by the way, can't do anything yet. So the draft Scottish budget came out on the 19th. It's must be stressed that it's draft, which means that it hasn't actually reached the Finance Act stage yet. It was presented as a draft budget, and I'll talk about that in a little while. But it's in draft, and nothing is set in stone. Those are the rates and the bans that will apply for 2024-25, and I cannot read any of those out because it's ever so boring. Just the top 2, the starter and the basic bands, increased by inflation. So people say, "Oh, Scotland, highest taxed place in the United Kingdom," and I don't even want to talk about that. But their thresholds for the lowest paid did increase by an inflationary measure. The ones for Wales and the rest of the England and Northern Ireland did not increase. What they did introduce, though, was a new band of tax. So that's just Scottish advanced rate. So you've already got 19, 20, 21, 42, 47 it was. Now they've introduced in the middle the Scottish advanced, payable at 45, and the Scottish top, which was the Scottish higher. They changed it. It's called the Scottish top, has gone from 47 to 48 pence. In the pound. Now, there's not an awful lot you can do, to be quite honest. That is what the government want to do. If that's what goes through as a Scottish rate resolution, then that's what your software will have to do. I think you should be aware of a particular band of earnings, which is that band there, which is inclusive of the personal allowance, 43,663 up to 50,270. Now, in rest of the UK countries, 50,270 is the point that we stop paying basic rate tax and start to pay higher rate tax. We cease to pay national insurance at the highest rate at 50,270 because that's the upper earnings limit. But it's not that in Scotland. They will pay tax at a higher rate before reaching the upper earnings limit. So effectively, with the tax that they pay and the national insurance at the higher rate, you could get a Scottish taxpayer saying, well, my marginal tax rate, my effective tax rate on my earnings, because I fall in that band, is 52%. If I was working just over the border in England, it would be much less. And again, there's nothing that you can do about that. That just is the way that it is. But I think it's good that bookkeepers, accountants, agents are just aware of it. There's nothing that can be done. That's the way it is. That's the way it is. National insurance is a UK-wide thing, so it applies in Scotland with UK-wide thresholds. But Scotland can do what they like with regards to tax, regardless of what the rest of the UK does. It's just an implication of the sharing of income tax powers. Draft Welsh budget, so it's draft, it hasn't been finalised, it hasn't made it through to an act of the Senedd, the Welsh Parliament. So basically what that slide is saying is that all the Welsh government can do is take the 20, 40, 45, and what the Welsh rates of income tax means is you deduct 10% from that, and then the Welsh government say, well, we'll put on a value. And what they've decided for next tax year, so it's 24, 25, is that they'll keep the Welsh rates of income tax as 10. So 20 minus 10 plus 10 equals 20. 40 minus 10 plus 10 equals 40. So no change, no change. And what the Welsh government have said, we have no plans to vary the Welsh rates of income tax as long as the economic impacts of COVID last. And I don't think they've actually given a definition of what is an economic impact of COVID. But I look at the draft Scottish budget and the draft Welsh budget, which was all made on the assumption that the personal allowances would be frozen at 12, 570, your marriage allowance is frozen, your tax rates would be 20, 40, and 45. I looked at that and I thought, the UK budget, you hear on the television, I know you shouldn't believe everything that you hear on the television or the radio, but you hear, oh, that there's going to be massive income tax changes. I thought, oh, please don't change income tax rates. Please don't change income tax thresholds, because the Scottish and the Welsh governments have set their budgets based on, well, this is what I thought it would be. If it's changed on the 6th of March, I can frantically see a lot of Welsh members of the Senedd and Scottish members of the Scottish Parliament frantically going around and changing their budget, because the resolution, the Scottish decision and the Welsh decision for Welsh rates of income tax must be in place before the start of the tax year. And if they're in place, they have to apply for the whole tax year. Now, if the current Chancellor of the Exchequer does something, oh, I'm going to, the basic rate of income tax is going to go down to 18%. I can imagine Wales like, oh, flipping heck, what are we going to do? What are we going to do? This affects the money that's coming into us. Maybe we'll change our Welsh rates of income tax. Similarly, in Scotland, I talked about the Green Book, autumn statement, always a Green Book, spring statement, as it used to be, was blue. Budget is always red. I find it interesting. Lots of speculation about how much headroom the Chancellor of the Exchequer had to, well, he could do this, he could tweak this, he could tweak that. And there's an awful lot that he could do to perhaps appeal to the electorate who might say, you know, this is really good. I'll vote for these people again. But that's really interesting, that report from the Institute of Fiscal Studies, which said, actually, whatever is done at the budget, possibly a giveaway budget, the country can't really afford. And the next government coming in is going to have to actually get that money back somehow. So that's an interesting report. Oh, I found it an interesting report. Okay. 24, 25. This is based on all of the things that we know, but I always have to think, well, we know them now, but they could all change depending on what the budget says. Hopefully he won't do anything. Excuse me. Okay, so like I said, 2024, I will put down all of the tax rates, the national insurance rates, the SSP, the SMP. I'll consolidate everything for the UK and also the Isle of Man. I will do everything. But as I said earlier on, what I've been doing is this is changing, this is going up. And so it makes sense to do the bits that we didn't know, makes sense to pass that information on to you. But I will consolidate everything into our rates and allowances guide. We knew, always think in the back of your mind, please, please, Chancellor of the Exchequer, don't change anything that we knew. And I'm sure that software developers will think exactly the same. They believe that the personal allowance is frozen. They believe that the marriage allowance is frozen. They believe that they know the tax rates are 20, 40, and 45. They believe that they know the bandings. Please don't change them in the budget. Or if you change them, don't change them to be effective July. What a palaver a mid-year change is. Anyway, that's always me, my half-empty thoughts. Please don't do anything on the 6th of March. So we know that the tax allowances and thresholds are frozen indeed. And I was surprised to see the P9X for 2024 come out, which tax codes you should use for the next tax year. Bearing in mind, we have to wait for Scotland and Wales to pass their resolutions for what they've said about Scottish tax and Scottish and Welsh income tax as well. So we know it, but those two resolutions have got to go through. We know the national insurance thresholds and rates. We know that unchanged. Employment allowance, £5,000, unchanged from the current tax year. National minimum wage and living wage, we know that it's increasing from the first pay reference period on or after the 1st of April. We know that information. Statutory payments, SSP is going up by an inflationary measure. SMP, SAP, SPP are going up by an inflationary measure. So we knew that information. Apprenticeship levy, we know that's frozen. So that's your £15,000 and your 0.5% of your pay bill. No changes there. Cars and vans, great. No changes for next tax year. So if you know them for this tax year, good, because they're going to apply for next tax year as well. Anybody that's construction industries scheme, bear in mind that there are going to be reforms from April 2024, largely to do with compliance, VAT compliance, or compliance with all tax liabilities to gain and retain gross payment status. So if you're into CIS, have a look at that consultation response. Look at the changes that are happening from April 2024. Lifetime allowance. If you're lucky enough, and any of your clients, the employees of your clients are lucky enough to have pension savings over £1 million, the lifetime allowance charge went last year, 2023, the actual allowance itself is going from April 2024. But that brings with it other things. So I'm not going to talk a load about it, but if you need more information, have a look at that policy paper, lifetime allowance newsletters as well. They're quite an interesting read, if you like that kind of thing. There's a link to some information on gov.uk which confirms all of that. So we knew that information. We now know more information. Student loan thresholds. Yes, we didn't know that until, when was it? HMRC told us this week, I think. Yeah, they told us this week, and we've been asking for ages. What are the thresholds? The annual threshold. We knew one. We were told last year, Plan 2, it wasn't going to change from that in 2023-24. Well, I don't know why we needed the Department for Education to tell us that there wasn't going to be a change, because I could have told them that. It's in legislation. Plan 4, we were advised, software developers were advised in December that that's increasing. That's your Scottish student loan. Plan 3, which used to be the postgraduate, was the one that we were waiting for. There was a lot of discussion about we want that threshold to go up so that somebody that's repaying a postgraduate loan can earn more money before they actually have to repay their postgraduate loan. We were waiting and waiting and waiting. And anyway, they just confirmed this week. I think it was a palaver between the English, the Department for Education wanted to do one thing, but had to get agreement from the Welsh Department for Education and Skills, I think it's called. And they got that agreement, and now they published. So that's no change. 2 freezes, 2 and 3 are frozen, 1 and 4 increment. Great. Auto enrollment, that is really not exciting at all. I wrote about this for ICB members. Hasn't been published yet by the pension regulator, but there's a written statement in the House of Commons from the current pensions minister who said, we've carried out a review and the thresholds that are in place at the moment are okay, and we're going to keep them in place for next year. But the thresholds that are in place at the moment are the thresholds that have been in place for a couple of years now. So I think it's good that they're frozen, particularly the lower qualifying earnings band, which is going to go anyway when we get a new government. It's going to go anyway. So it would be stupid to increment it. The upper limit, you look at that figure, 50,217. What does that remind you of? Oh, that's the the threshold at which people start to pay higher rate tax in rest of the UK countries, not Scotland. It's also the upper earnings limit. So if the upper earnings limit changed and that threshold changed, would that change? Oh, goodness. £10,000. It's been £10,000 for years and years and years, the earnings trigger, because it was aligned to the personal threshold, personal allowance, which was £10,000 years and years and years ago. Anyway, no change there. And this came out today, or was publicized today, all the rates and thresholds for employers for tax year 2024-25. So that's a good read. And what we don't know at the moment, so we knew some bits and pieces, I've just relayed that. We now know more bits and pieces, I've just relayed that. What we don't know, payroll and employment law, is the value of a week's pay for redundancy purposes, that kind of thing. Should know that the Great British legislation comes out March time, Northern Irish legislation comes out right at the last minute. So we don't know that yet. And I keep talking about this, real doom and gloom. We don't know anything that we do know now. We don't know if that's going to be impacted by anything that the Chancellor of the Exchequer might say on the 6th of March. So, excuse me, I'm talking so quick. I'm going to keep up with Martin Lewis, I think, because he talks so quick. Number of considerations. I have put on slides, which I'm not going to show you, but they're on slides that you will get, but I'm not going to show these slides. The impact, the importance of Form P9X, which has just been published on gov.uk, the consideration that you should be thinking, have I got a weekly payroll and there's 53 paydays in the tax year rather than 52? Have I got a lunar payroll and there's 56 weeks rather than the normal normal number of weeks? I've just put a slide on there. Consider, have I got more paydays this tax year, 53, a 52, or a 56, week 56? Director payrolls, this is all to do with the annual reconciliation. Remember, if they're a director and they're on a normal payroll, paying normal national insurance, you've got to do an annual reconciliation in the last payday of the year. And then what about writing to your clients? And I used to do this when I was in live payroll, working for a payroll bureau. You would write to all clients, and you would say, are you still entitled to the employment allowance? Last year you did get the employment allowance. Are you still entitled to it? Because it's an annual thing now that you have to say to HMRC, this client is eligible for the employment allowance. You have to tick the box. Apprenticeship levy allowance, that £15,000, do they want it allocated the same way next year as it's allocated this year? Are you still a small employer? You were a small employer, you're able to claim 103% back of your statutory maternity pay, your adoption, your paternity. You're a small employer. Are you a small employer for next year? Because you need to indicate that in your software as well. And then the basic earnings assessment. So this is where you've got people on your payroll that have got childcare vouchers, scheme closed in 2018. They've got childcare vouchers, and the basic earnings assessment is a way that the employer has a responsibility, the employer has a responsibility, but they'll possibly ask you, but it's them that have got the responsibility ultimately. If they go over a certain amount of money, that you have to restrict the amount of tax and national insurance relief they get through the payroll. Annual thing, the basic earnings assessment. So they are on slides which I'm not going to show. What I do want to talk about is the changes to statutory paternity leave and pay, which come in from the 6th of April. Where's my little, oh, yes, because it must be in software, your clients or your own policies and procedures will have to be updated, and this applies in Great Britain. And if you remember me talking ages and ages ago about me saying to HMRC, well, what about somebody that's in Northern Ireland and they're on a Great British contract? Did they get it? Or does it just apply to people actually physically in Northern Ireland? An answer, haven't got a question I haven't got an answer to yet. Anyway, statutory paternity leave and pay is changing from April 2024, only a few weeks' time. Currently, the leave and the pay has to be taken within 56 days of the birth or the placement of a child. Now it can be taken in the first 52 weeks of the date of birth or the date of placement. That's 2 weeks. So the person will say, I only want a week, and then they'll come back and they'll say, oh, actually, I wanted 2 weeks. That's too late. It's too late. You said you wanted a week, and that's all you're entitled to. Now, and you have to take it continuously. Now that 2 weeks can be taken discontinuously. You might hear that, or non-consecutively. So somebody might say, oh, well, my baby's born in May. I'm going to have a week off then, and then I'm going to have a week off to be with the child around Christmas time or something like that. So that 2 weeks can be separated. It doesn't have to be now a continuous block. It can be discontinuous. There's 2 notifications, and this really is not, it's not really highlighted anywhere, but there are 2 notifications that the employee must give the employer. If they give if the employee gives it to the employer, if you're doing the payroll, will probably give the information to you. But what the employee should be giving the employer is 15 weeks. So the qualifying week in birth cases, the matching week in placement case, in adoption cases, they should be saying to the employer, I'm entitled to statutory paternity leave and pay. Basically, yeah, a notice of entitlement. I'm entitled to it. Then, to ensure that there's more flexibility around taking the leave, 28 days before they want to start it, they will say to the employer, I told you a few months ago that I was entitled to it. Now I'm giving you 4 weeks notice because I want to start it. And there are cases where the employer can say, can you take it a week later, or can you take it a week earlier, or but generally you can't can't refuse, but you can negotiate those dates. But the two notifications, notice of entitlement, I'm entitled, notice of leave, I told you I was entitled, now I want to take the leave. Those are your amendment regulations. They come into force on the 8th of March. Why the 8th of March? The 8th of March is 28 days before the 6th of April. Now, the legislation actually applies to births where the birth is on and after the 7th of April. Now, the guidance that comes out, the agent update, which I've given you a link to there, you have to read it very carefully. I missed it a couple of times. So with regards to birth, it says changes for births after the 6th of April. Well, a birth after the 6th of April means on and after the 7th of April. But placements, it says placements on and after the 6th. There is a difference. The issue could be that someone's baby is due on the, say it's due on the 6th, no, say it's due on the 7th, say it's due on the 7th of April, but the baby comes early. And the employee says, well, I want to use my paternity leave flexibility because the baby was expected then. I didn't expect it to come early, so I want to use the flexibility that I'm entitled to. Fine, that's the way you should do. However, in payroll systems, you are using a system that's got inflexible statutory paternity leave and pay, but you're supposed to be operating flexible statutory paternity leave and pay. So just have a look at that agent update if that applies. You're only looking at a baby that was born, that's due in that period, 7th of April and a few days afterwards, but the baby comes early after the 7th of April. It's never going to apply again. Read the agent update if that does happen, because it says you've got to be flexible, and there could be problems with your software reclaiming 2 weeks. Say that the baby is born early and the father says, I want my 2 weeks now, before the start of the new tax year. Your software won't be able to do it, and your software won't be able to do a reclaim for that 2 weeks. Have a look at the agent update, and hopefully that doesn't happen. If a baby is expected on the 7th of April but comes early, best just don't tell me. I don't want to know. I don't want to know. So that's statutory paternity leave and pay changes. Now, working time regulation changes. This applies in Great Britain. Again, the big confusion, what about people working in Northern Ireland that are under a Great British contract? Are they governed by the Northern Irish working time regulations? Or it's very confusing. So waiting for HMRC to come back and DWP to come back on that. That's your piece of legislation. The guidance link that I've given there is to the holiday pay changes. So I think that's going to be really, really relevant. So there are changes, or many important changes, but 3 important dates. The first one is changes from the 1st of January. So there was a piece of European Union case law which said employers, to ensure that employees, workers, I beg your pardon, to ensure that your workers aren't working more than the weekly maximum, 48, you've got to record daily working hours. Well, I never have known an employer record the daily working hours. Well, Ian Holloway works this, well, she works this, well, she works. I've never known that. Of course, you've got to keep enough hours to make sure that I'm paid at the national minimum wage, but I've never known the recording of daily working hours. Anyway, that European case law, because we're no longer part of the European Union, we don't have to worry about that anymore. So employers that were doing it don't have to do it anymore. Those regulations have been repealed. Now, those regulations allowed a worker to say to their employer, well, I was going to go on holiday. However, there were restrictions, COVID-related restrictions in Barcelona, in Tenerife, in Malaga, or whatever. Or I had COVID, my wife had COVID, my kids had COVID, something we were self-isolated, all that kind of thing. Thankfully, that isn't around so much anymore. Therefore, the government have said, well, we're going to, oh, what have I done? Oh no, what have I done? That's me crossing my legs. Government have said, well, we don't need those regulations in place anymore. So if a worker has used those regulations to carry forward leave, that's perfectly fine, but any leave that was carried forward must be used by the 31st of March this year. There was a piece of case law, we've always been doing this, there was case law that said, if I'm sick and I can't take my leave, I can carry it forward. If I'm on maternity leave, I'm enjoying that period of statutory leave, but I'm also entitled to holiday leave, but I can't mix holiday leave and maternity leave. Therefore, my holiday leave I want to carry forward. There was case law to say that, but it was never written into legislation. Now it is written into legislation. So if somebody is sick for 3-4 weeks, oh, just the weeks that I was going to go on holiday, I can't take my holiday entitlement now. Oh, well, because you were sick and you couldn't take it, you can carry that forward for up to 18 months. So you must use it within 18 months of it being carried forward. And have a look at this part of the regulations, Regulation 3, and search to Control F and look for 3ZA, because what it's done is it's clarified the definition of the pay that should be paid when somebody takes holiday leave. A lot of the way that we were calculating the pay to be paid when somebody takes their holiday leave was as the result of what was in legislation. And well, this bit of case law said that, and oh, that impacted this, and all this bit of case law said that, and we were putting it all together and trying to form a definition of what constituted pay, because it was never clarified in regulations. Now we're not in the European Union, so we don't need to look at this bit of this bit of case law, this bit of case law, this bit of case law. Now there is a definition in the amended working time regulations, the Great British working time regulations anyway, of what constitutes pay. And it's very similar to the definition that we were using before. So your overtime that's normally worked, your commission, your performance related things, allowances, that kind of thing. So have a look at that. But those were effective the 1st of January 2024. Now, for leave years that start on and after the 1st of April. Now, I did speak to communicate with a bookkeeper who had a client whose leave year did start on the 1st of April, and that's absolutely fine. Every company has a different leave year, but most companies will have a leave year, in my experience anyway, that starts on the 1st of January. So this change here, for irregular hours workers and part-year workers, this change here will not actually have an operational impact at most employers until the 1st of January 2025, when their next leave year begins. But if you've got a leave year starting in April, like this lady had that contacted me, or May, June, July, these changes come into effect. So look at the guidance, and I will be doing more webinars on this. I'm going to be talking at the Festival of Accounting and Bookkeeping about this as well with somebody else. what it says is this is an irregular hours worker. This is the definition of an irregular hours worker. And this is the definition of a part-year worker. A part-year worker, somebody that's paid for 12 months of the year, but only actually works part of it, basically. This is the definition, and this is how, for an irregular hours worker, you calculate the leave entitlement. And for a part-year worker, this is how you calculate the leave entitlement. Also, what it does, it allows for leave years that start on or after the 1st of April, it allows the employer to use rolled up holiday pay if they want. And simply for an irregular hours worker or a part-year worker, as long as you, the minute, the time that you pay them their salary, their wages for the week, the month, the period, 12.07% of that, if it's shown as a separate pay item, can be put down as rolled up holiday pay. The implication of that is that the employee will still accrue holiday leave as per the guidance. They'll still accrue holiday leave, but they'll have been paid for their leave before they take their leave. So they're still entitled to their leave, and the employer should make sure that they take their leave. But the employer should say to the employee, when you go on leave, so you book your 2 weeks leave, when you book your leave, don't forget you've actually been paid for it. So really what you should do when you get your pay, that 12.07%, you should be putting that away. And you should think, well, that's the pay that I'll use when I go on leave. It won't happen. It won't happen at all. And people will just see that as part of the wages. But the impact of rolled up holiday pay, they're getting holiday pay at the time they're earning, but they're still entitled to leave. When they take their leave, they will not get paid. Okay, so that's for 1st of April 2024. I will be going into more detail on that in future webinars. Guidance, please have a read of the guidance. TUPE transfers, if this affects you, have a look at those regulations. A TUPE transfer, so this is a transfer of undertakings, protection of employment. It did apply to micro employers. Now the rules are applying to not only micro employers, but small employers. So if that applies, do have a look at that. But a few bits of employment law I want to talk about. I hope I haven't sort of like hurried that through. There's so much to get through. Great Britain again, software, it could affect. Your processes, your procedures, your policies, it could affect. This is probably not a bookkeeper responsibility, an agent responsibility. That bit of legislation went through last year, effective the 6th of April. Basically, there were already redundancy protections in place in the cases of maternity, breastfeeding, that kind of thing, before and after the birth. Those protections have been extended by that legislation. Would bookkeepers and agents get involved with that? Not really, but you should be aware of it. Employment Relations Flexible Working Act. Flexible working could affect bookkeepers, agents, accountants, anybody doing payroll. Because if somebody says to their employer, well, because of these regulations and this draft code of practice, I can request to work flexibly now. I can request to work flexibly more times a year than I could previously. Always been a right to request flexibly. This says you can request more times. You can request to work flexibly. If the employer grants that, and there is an obligation now to consider that rather than just saying, oh no, not her again, the employer will say, yeah, this person's going to work flexibly. How does it affect bookkeepers and agents and accountants? They're going to have to adjust the payroll, unfortunately. So it does affect. Carers leave could affect bookkeepers, because if an employee is a carer and they've got a dependent with a long-term care need, they can say to their employer, well, new legislation has come into force and I can take 1 week's unpaid leave. If they do, the employer, if they haven't got an occupational policy, the employer will say to you, the person processing the payroll. Bill is looking after whatever he's doing. You don't need to know why he's taking it. Can you stop his pay for a week? So therefore, you're going to have to calculate a week's pay and deduct that from someone's pay in the month. So just be aware of those. This is, and I'm really quite. Am I looking forward to it? No wonder Martin Lewis has to take so many drinks. Sure, I'm trying to keep up with him. Payrolling of benefits. Now, currently, and since April 2016, we have been able to say to HMRC, as long as we register by 10 o'clock on the last day of the tax year, as long as we register, we've been able to say to HMRC, I have been sending you P11Ds, and I've had medical benefit on there, and I've gym membership on there, and I've dental insurance on there as well. Do you know, from next year, so from tomorrow, if you register on the last day of the tax year, I am going to put the value of that benefit, rather than on the P11D, I'm going to put it through the payroll. If you register, you can immediately think to yourself, phew, I need to stick it through the payroll now, rather than put it on the P11D at the end of the year. What HMRC will do is they'll look at everybody's tax code on that PAYE reference, as long as you haven't excluded the person. They'll look at everybody's tax code on that PAYE reference, and they say, right, okay, there's medical benefit in there, reducing the personal allowances, so we're getting a lower tax code. Well, I'm going to take that out, because what the employer has done, they've told me that that is going to be taxed at source in real time. So we'll take that out. We'll take the dental benefit out. We'll take this out. We'll take that out. So the personal allowances increase. They're allowed more personal allowances in the payroll. However, there's more going through the payroll that's subject to tax. So it evens out at the end of the day. Good thing for HMRC, things come out of the tax code. Good thing for employers, there's no P11D completion at the end of the year. Confusion, explain it to employees. Well, actually, rather than put it on a P11D and include it in your tax code, it's now going to go through the payroll. So you're going to pay more tax on a monthly basis. But I don't want to pay tax twice. Oh, you won't pay tax twice. So it's very confusing, very confusing. But this update, and we expected it, and I'm glad that His Majesty's Revenue and Customs have done something about it. And I've always said anything that's voluntary doesn't stay voluntary for very long. From April 2026, every employer that has benefits will have to payroll them rather than complete a P11D. But it has a number of considerations. And the first consideration that came to me, having worked for an employer like this in the past, was, well, there's so many clients I do the payroll for, and I said, well, I'll do your payroll, and if you want me to do the P11Ds, I'll charge you £10 per person or £20 per person, and if it's really difficult, I'll do £50 per person. It's an income stream, and I can remember it being at a company before, and I said, you know, really, we ought to be encouraging our clients to payroll benefits, so we put them through the payroll rather than the palaver of completing a P11D. I said, well, you've got so-and-so there. She's just employed to do P11Ds at the end of the year, and we make hundreds of thousands of pounds for P11Ds. Ian, why are you telling me as an employer to do away with an income stream? I said, I wasn't telling you to do away with an income stream. I'm just telling you that the reality is, it's voluntary now. It's going to become mandatory. You need to think about this. The many companies make their money from P11D production. If this is you, just think, right, okay, that revenue stream is going to go. So the last time that I will be doing P11Ds will be April, May, June 2026 for the previous tax year. Then that income won't be there anymore. However, the specialism that's required to generate that income, that's still required. That's still necessary. All that's happening with this, I say all that's happening with this, but the P11D knowledge that's required in 6-8 weeks at the end of the tax year, it's going to be required for 52 weeks now. So the knowledge is still required. It's just spread. Maybe that's what needs to happen with your income. If you're used to the big income at that period of the year, you need to spread that income. But not all currently benefit, currently, not all benefits can be payrolled. And the two ones that can't are accommodation benefits. So where giving you employment. Oh, there's a company flat. Oh, it's taxable, that company flat. And the utility bills that we pay is taxable. Beneficial loans, so it's any loan that you make to your employer over £10,000 that is charged at an interest rate that's less than HMRC's official rate. That's the definition of a beneficial loan. Now, personally, I've done beneficial loans. I haven't really done accommodation a lot. And I would have said, with the majority of agents, bookkeepers, and accountants, that accommodation and beneficial loans are not your big ones. But there's a lot of companies out there that make their money from just doing P11Ds, from accommodation benefit and beneficial loans. Anyway, if mandatory payroll is coming in April 2026, those two need to be included. But definitely, we are going to have to look at the way that we work, the policies that we have, the procedures that we have, the collection of information. We need to gather that information in real time, not just at the end of the year. We need to be getting the information as and when the person enjoys the benefit. So rather than the client saying, oh, yeah, their medical benefit was £500 for the course of the year, and they tell you in April, we need that information on a monthly basis. Now, if we're going to process it, now the simplification update that was issued in January did say we are going to legislate for the reporting of P11D, reporting of benefit in kind information via RTI, and the payment, recording, reporting, and payment of Class 1A in real time. And as soon as I read that, I thought, Class 1A in real time, that's an annual liability. So it's a bit of a legislation change there in the first place. But does an employer really want to convert an annual liability into a real-time monthly liability? So along with your tax, your national insurance, you also pay Class 1A on the benefits in kind. That's something to look out for. Making good dates, they're not aligned. That needs to be looked at. It's all of the administration. Dear client, I don't need that information about that person's company car. I don't need it in May. I need it every month. So every time they've gone from a full Cortina to a mini Metro, I need you to tell me when they gave up their full Cortina. Not Cortina, I can't think of a posh car. When they gave up their car and they've gone to another car, I need you to tell me the dates that they've gone, and you need to give all the details, because I need to record that in the payroll. When somebody has got medical benefit and they've got single cover, but they got married and then they get divorced and then they're single parent, I need you to tell me that in real time. You tell me when the salary is changing. You're going to have to tell me about benefits now. That's big. We've got 2 years to sort it out. But I have suggested to HMRC via a body that we really need to talk about this in a structured way. If we don't talk about the payrolling of benefits in a structured way, let's deal with this issue first, and then this issue, then this issue. If we don't do it in a structured way, it's going to be a palaver. So, transition into 2024. Scottish and Welsh budgets in draft. Our UK budget, we're really going to be exciting, really going to be exciting. I think we know almost for tax year 2024-25, as long as the UK budget doesn't interfere with things. The big thing, I suppose, with regards to the employment law changes, is the paternity leave flexibility. With regards to working time, is the changes to holiday leave and pay from the 1st of April. So if you've got a holiday year that starts now, it's not going to be effective until 2025. It's only for holiday years starting on and after the 1st of April. But payrolling benefits is going to be an interesting one. I think it's going to keep me busy for the next 2 years. See me out. Jasmine, I'm finished now. I'm dry as a bone.
Thank you so much, Ian.